Question 1. A registered representative, R, recommends a complex option strategy to a client involving multiple legs. Which of the following is the best action for the Series 9 and 10 principal to take regarding the suitability of this recommendation? Approve the trade immediately if the client has declared previous options trading experience. B. Review the client's options trading history, financial situation, investment objectives, and risk tolerance, then approve or disapprove based on the overall assessment. C. Contact the client directly to confirm their understanding of the risks, then approve the trade. Require the RR to complete additional options training before submitting any complex options recommendations. Answer B. Review the client's options trading history, financial situation, investment objectives, and risk tolerance, then approve or disapprove based on the overall assessment. For any options recommendation, especially complex strategies, the Series 9 and 10 principal's primary responsibility is to diligently assess the client's suitability. This involves a comprehensive review of all relevant factors, including the client's financial profile, investment objectives, risk tolerance, and prior options experience, to ensure the strategy is appropriate. Simply relying on the client's declared experience or a direct call is insufficient without a thorough suitability analysis. Requiring additional training for the RR might be beneficial in general, but it does not fulfill the principal's supervisory obligation for the specific transaction in question. Question 2. A Series 10 principal discovers that a registered representative, RR, at their branch office has been engaged in selling away, without the firm's knowledge or approval. Which of the following actions is the most appropriate for the principal to take? Immediately notify the client involved and offer to unwind the transaction. B. Conduct an internal investigation, document findings, notify the firm's compliance department, and consider filing a Form U-5 amendment or other regulatory reports if required. C. Counsel the RR privately and warn them against future unauthorized transactions. Require the RR to cease the activity and return any commissions earned from the unauthorized sales. Answer B. Conduct an internal investigation, document findings, notify the firm's compliance department, and consider filing a Form U-5 amendment or other regulatory reports if required. Upon discovering selling away, the principal's immediate and most appropriate action is to initiate a formal process to address the violation. This includes conducting an internal investigation to gather all facts, documenting the findings thoroughly, and promptly notifying the firm's compliance department. Depending on the severity and nature of the selling away, regulatory filings such as a Form U-5 amendment, if the RR is terminated or subject to disciplinary action, or other required reports may be necessary. Simply notifying the client, counseling the RR, or demanding return of commissions does not fulfill the firm's regulatory obligations to investigate and report misconduct. Question 3. According to FINRA rules, what is the maximum gift value a principal may permit a registered representative to give to a client annually without violating the rule? Any amount, provided it is disclosed to the firm. B. $250 per person per year. C. $100 per person per year. D. $50 per person per year, not including business entertainment. Answer C. $100 per person per year. FINRA Rule 3220, known as the gift rule, prohibits registered representatives and firms from giving anything of value in excess of $100 per person per year to any person where the gift is in relation to the business of the recipient's employer. This rule aims to prevent the undue influence that gifts might have on business decisions. It's important to distinguish gifts from legitimate business entertainment, which is generally not subject to the $100 limit, provided it is not excessive and the representative attends the event. The principal's role includes supervising compliance with this rule. Question 4. A client requests to open a discretionary account. Which of the following is required before any discretionary trades can be executed? The client must sign a discretionary authorization form and the account must be approved by a Series 10 principal. B. The registered representative must pass an additional discretionary trading exam. C. The client must maintain a minimum account balance of $25,000. The firm's legal department must review and approve each discretionary trade individually. Answer. The client must sign a discretionary authorization form and the account must be approved by a Series 10 principal. Before a registered representative can exercise discretion over a customer's account, two critical steps must be completed. The customer must provide written authorization, and a Series 9 and 10 principal must approve the account for discretionary trading. This dual approval process ensures that the customer understands the implications of granting discretion and that the firm supervises such accounts appropriately. Neither an additional exam for the RR, a minimum account balance, nor individual trade approval by legal is a general requirement for opening a discretionary account. Question 5. A Series 10 principal receives a written customer complaint alleging a material financial loss due to a registered representative's misconduct. What is the firm's obligation regarding this complaint? The principal should attempt to resolve the complaint directly with the customer within 30 days, without involving FINRA. B. The firm must report the complaint to FINRA within 10 business days of its discovery if it alleges theft, misappropriation of funds or forgery, or involves significant customer harm or regulatory scrutiny. C. Only complaints involving options need to be reported to FINRA. The firm is only required to maintain a record of the complaint for regulatory inspection, not to report it immediately. Answer: B. The firm must report the complaint to FINRA within 10 business days of its discovery if it alleges theft, misappropriation of funds or forgery, or involves significant customer harm or regulatory scrutiny. FINRA Rule 4530 mandates that firms report certain customer complaints to FINRA within 10 business days of their discovery. This includes complaints alleging theft, misappropriation of funds, forgery, or those involving significant customer harm, regulatory scrutiny, or a material financial loss due to misconduct. While firms should attempt to resolve all complaints, the reporting obligation for specific types of complaints is crucial for regulatory oversight. All written complaints, regardless of severity, must be recorded and maintained, but the most serious ones require prompt notification to FINRA. Question 6. Which of the following describes the primary responsibility of a Series 9 options principal? To supervise all options sales activities and ensure compliance with exchange rules and FINRA options regulations. B. To manage the firm's proprietary options trading accounts and execute complex options strategies. C. To develop and market new options products to institutional clients. D. To administer the firm's options clearing and settlement processes. Answer: to supervise all options sales activities and ensure compliance with exchange rules and FINRA options regulations. The primary responsibility of a Series 9 options principal is to supervise all aspects of a firm's options sales activities. This includes ensuring compliance with all applicable exchange rules, FINRA options regulations, and the firm's own internal policies and procedures. This supervisory role encompasses reviewing options accounts, approving options communications, and ensuring the suitability of options recommendations. While other roles listed are related to options, they do not define the core supervisory function of an options principal. Question 7. A registered representative, RR, wants to engage in a private securities transaction, PST, for compensation which involves selling securities away from the firm. What is the firm's obligation upon receiving written notice from the RR? The firm must approve the transaction, provided the RR informs the firm of the details. B. The firm must disapprove the transaction to prevent liability. C. The firm must provide written approval or disapproval. If approved, the firm must record the transaction on its books and supervise the RR's participation as if the transaction were its own. The firm only needs to acknowledge receipt of the notice. No further action is required. Answer: C. The firm must provide written approval or disapproval. If approved, the firm must record the transaction on its books and supervise the RR's participation as if the transaction were its own. FINRA Rule 3280, regarding private securities transactions, PSTs, requires a registered representative to provide prior written notice to their firm if they intend to engage in a PST. If the PST involves compensation, the firm must provide written approval or disapproval. If approved, the firm is then obligated to record the transaction on its books and records, and supervise the RR's participation as if the transaction were executed by the firm itself. This rigorous supervision is in place to protect investors and ensure regulatory compliance, holding the firm accountable for transactions that compensate its representatives. Question 8. A Series 10 principle is reviewing a branch office's procedures for handling incoming mail. Which of the following is a critical supervisory consideration for mail that might contain customer funds or securities? Mail containing funds or securities must be opened by at least two principals to ensure accuracy. B. All incoming mail must be opened by a non-registered administrative assistant to prevent RRs from accessing client funds. C. Mail containing customer funds or securities must be promptly logged, recorded, and delivered to the appropriate department, with supervisory review of the process. Customer mail should be held unopened until the specific registered representative responsible for the account can personally review it. Answer: C. Mail containing customer funds or securities must be promptly logged, recorded, and delivered to the appropriate department, with supervisory review of the process. A critical supervisory consideration for mail containing customer funds or securities is the establishment and enforcement of procedures for prompt logging, recording, and delivery to the correct department. This process should be subject to supervisory review to prevent misappropriation or delays. It's not necessarily required to be opened by two principals, nor should it be held unopened for an RR, as this could lead to delays or unauthorized access. Opening by a non-registered assistant is permissible if appropriate controls and supervision are in place, but the most crucial aspect is the documented process and supervisory oversight. Question 9. Regarding supervision of correspondence and retail communications, which statement is most accurate? Both correspondence and retail communications must be approved by a principal prior to use and filed with FINRA. B. Correspondence typically does not require principal pre-approval, but retail communications generally do. C. Neither correspondence nor retail communications require principal pre-approval if the content is solely educational. All communications with the public, regardless of type, must be filed with FINRA at least 10 business days prior to first use. Answer: B. Correspondence typically does not require principal pre-approval, but retail communications generally do. FINRA rules distinguish between correspondence and retail communications in terms of principal pre-approval. Retail communications, advertisements, sales literature distributed to more than 25 retail customers within 30 calendar days, generally require principal pre-approval before first use, and some types must be filed with FINRA. Correspondence, written communications distributed to 25 or fewer retail customers within 30 calendar days, typically does not require principal pre-approval, but firms must implement systems for post-use review and supervision. The level of supervision and filing requirements depends on the classification of the communication. Question 10. A firm is acting as an underwriter for an all-or-none offering. Which of the following is a critical supervisory responsibility related to the escrow account for this offering? The principal must ensure that all funds received from investors are promptly deposited into the firm's general operating account. B. The principal must verify that funds are deposited into an escrow account held by a qualified independent bank and that investors' funds are returned promptly if the contingency is not met. C. The principal is responsible for investing the funds held in escrow to generate a return for the issuer during the offering period. The principal must ensure that the escrow agent is a registered representative of the underwriting firm. Answer: B. The principal must verify that funds are deposited into an escrow account held by a qualified independent bank and that investors' funds are returned promptly if the contingency is not met. For contingent offerings like all or none, a principal's critical supervisory responsibility is to ensure that investor funds are held in a qualified escrow account at an independent bank or similar financial institution. These funds must remain segregated from the firm's assets until the contingency, the minimum offering amount, is met. If the contingency is not met by the specified date, the principal must ensure that all investor funds are returned promptly without deduction. The escrow agent must be independent, not a representative of the underwriting firm, and funds cannot be used or invested by the firm during the contingency period. Question 11. Under MSRB rules, how often must a municipal securities principal, Series 10, review the activities of municipal securities representatives and the municipal securities business of the firm? Daily. B. Weekly. C. Monthly. A. Periodically and at least annually. Answer: A. Periodically and at least annually. MSRB Rule G27 on supervision requires that municipal securities principals review the activities of municipal securities representatives and the municipal securities business of the firm, periodically and at least annually. This ensures ongoing oversight and compliance with MSRB rules and firm policies. While more frequent reviews may occur based on the firm's internal procedures or specific circumstances, the minimum regulatory requirement is at least annually. This periodic review helps identify and address potential issues before they become significant violations. Question 12. Which of the following scenarios would most likely trigger a suspicious activity report? A. Filing by a financial firm. A client making frequent cash deposits of $5,000 to their brokerage account. B. A client requesting to transfer $100,000 from their brokerage account to a personal bank account. C. A new client opening an account with a significant deposit, providing inconsistent identification, and requesting immediate wire transfers to multiple foreign accounts. A long-term client engaging in frequent, legitimate-looking options trades that generate moderate profits. Answer: C. A new client opening an account with a significant deposit, providing inconsistent identification, and requesting immediate wire transfers to multiple foreign accounts. A suspicious activity report, SR, must be filed when a firm detects a transaction or series of transactions totaling $5,000 or more for financial firms that the firm knows, suspects, or has reason to suspect involves funds derived from illegal activity, is designed to evade Bank Secrecy Act requirements, or has no apparent lawful purpose. A new client with inconsistent identification requesting immediate wire transfers to multiple foreign accounts strongly suggests potential money laundering or other illicit activity, meeting the criteria for ASR. The other options describe routine or potentially legitimate activities that, without other red flags, would not typically trigger ASR. Question 13. A Series 9 principle is reviewing the advertising of a new option strategy. The advertisement includes hypothetical illustrations of potential profits. Which of the following is most critical for the principal to verify? That the advertisement states, past performance is not indicative of future results prominently. B. That the advertisement provides a balanced presentation of both potential risks and potential rewards, and clearly explains the methodology and assumptions used for the hypothetical illustrations. C. That the advertisement has been approved by the firm's legal department prior to use. That the advertisement targets only accredited investors who understand complex option strategies. Answer: B. That the advertisement provides a balanced presentation of both potential risks and potential rewards, and clearly explains the methodology and assumptions used for the hypothetical illustrations. When reviewing options advertising, particularly those with hypothetical illustrations, the Series 9 principle must ensure a balanced presentation of both potential risks and rewards. It is crucial that the advertisement clearly explains the methodology, assumptions, and significant limitations underlying any hypothetical illustrations. While a disclaimer about past performance is important, and legal approval is standard, the core regulatory requirement is transparency and fairness in presenting the potential outcomes, especially for complex products like options. Targeting only accredited investors is not a general requirement for all options advertising, though suitability remains paramount. Question 14. What is the primary purpose of FINRA's Business Continuity Plan, BCP, Rule 4370? To ensure that firms can immediately recover all customer assets in the event of any operational disruption. B. To require firms to establish and maintain a BCP to address emergencies and significant business disruptions, ensuring customers can access their funds and securities. C. To mandate that firms maintain a secondary data center in a different geographic region. To ensure that firms can continue trading proprietary accounts without interruption during a market-wide shutdown. Answer: B. To require firms to establish and maintain a BCP to address emergencies and significant business disruptions, ensuring customers can access their funds and securities. FINRA Rule 4370 mandates that firms establish and maintain a business continuity plan, BCP, to address emergencies and significant business disruptions. The primary purpose of the BCP is to ensure that firms can continue their critical operations and that customers can access their funds and securities, communicate with the firm, and effect transactions during a disruption. While specific recovery times or redundant data centers might be part of a BCP, the overarching goal is to prepare for and respond to various disruptions to protect customers and maintain operational integrity, not solely to protect proprietary trading or guarantee immediate recovery of all assets. Question 15. A Series 10 principal receives an anonymous tip alleging that a registered representative is engaging in unauthorized outside business activities. What is the principal's immediate responsibility? Disregard the tip as it is anonymous and cannot be verified. B. Confront the registered representative immediately to demand an explanation. C. Initiate a confidential internal investigation to gather facts and verify the allegations, consistent with firm policy. File a Form U-4 amendment for the registered representative, reporting the alleged outside business activity. Answer: C. Initiate a confidential internal investigation to gather facts and verify the allegations, consistent with firm policy. Upon receiving an allegation of unauthorized outside business activities, OBAs, even if anonymous, the principal's immediate responsibility is to initiate a confidential internal investigation. This investigation aims to gather facts, verify the allegations, and determine if any violations of firm policy or FINRA Rule 3270 have occurred. Confronting the RR without facts might compromise the investigation, and filing a U-4 amendment prematurely would be inappropriate without substantiation. Disregarding the tip is a failure of supervisory duty. Question 16. Under FINRA Rule 3230, telemarketing, what information must a telemarketer provide to a client at the beginning of a cold call? Their firm's net capital and balance sheet information. B. Their name, the firm's address, and a telephone number at which the firm may be contacted. C. Their name, the firm's name, and a specific product recommendation. Their Series 7 and Series 63 registration numbers. Answer: B. Their name, the firm's address, and a telephone number at which the firm may be contacted. FINRA Rule 3230, which governs telemarketing, requires that any person making a telemarketing call promptly disclose specific information to the called person. This includes the telemarketer's name, the name of the firm's address, and a telephone number at which the firm may be contacted. This disclosure is designed to provide transparency and allow the recipient to verify the identity of the caller and the firm they represent. Providing product recommendations or registration numbers are not initial disclosure requirements under this rule. Question 17. A Series 9 principal is reviewing a customer's account for options activity. The account shows frequent, small profit trades that generate high commission costs relative to the account's value. This pattern most likely indicates the customer is employing an effective short-term options trading strategy. B. The option strategies are consistently generating alpha for the portfolio. C. Potential churning or excessive trading for the purpose of generating commissions. The customer is an institutional investor utilizing advanced hedging techniques. Answer: C. Potential churning or excessive trading for the purpose of generating commissions. Frequent, small profit trades that result in high commission costs relative to an account's value are a significant red flag for potential churning or excessive trading. Churning is a prohibited practice where a registered representative executes trades primarily to generate commissions rather than to benefit the client. A Series 9 principal must investigate such patterns to ensure the activity is suitable and not excessive, taking into account the customer's objectives and financial situation. While some strategies involve frequent trading, the disproportionate commission costs suggest a potential abuse rather than an effective strategy or institutional hedging. Question 18. A Series 10 principal must ensure that all new account forms are approved promptly. What is the typical time frame required for principal approval of a new account? Within 24 hours of receiving the completed application. B. Prior to the entry of the first order. C. Within 3 business days of the first trade in the account. By the end of the calendar month in which the account was opened. Answer: B. Prior to the entry of the first order. FINRA rules require that a Series 10 principal approve a new account promptly, and critically, prior to the entry of the first order in the account. This ensures that the principal has reviewed the new account form, verified the customer's identity, assessed suitability information, and approved the account for trading before any transactions occur. Subsequent reviews are also required, but the initial principal approval before the first trade is a fundamental regulatory requirement for opening an account. This prevents unauthorized or unsuitable trading from occurring in an unapproved account. Question 19. A registered representative, R, creates a social media post discussing investment performance. Which of the following statements about this retail communication is most accurate? It does not require principal approval if it is posted only to existing clients. B. It must be approved by a principal prior to first use and is subject to content standards for retail communications. C. It is generally exempt from FINRA advertising rules if it is under 160 characters. It can be considered correspondence if viewed by fewer than 25 retail customers within 30 days. Answer, B. It must be approved by a principal prior to first use and is subject to content standards for retail communications. Social media posts that discuss investment products or services and are distributed to more than 25 retail customers, or are publicly accessible and intended for a broad audience, are generally considered retail communications. As such, they must be approved by a principal prior to first use and must comply with FINRA's content standards for retail communications, which include being fair, balanced, and not misleading. The type of platform, length of the post, or audience alone does not exempt it from these rules if it qualifies as a retail communication. Correspondence classification applies to written communications to 25 or fewer customers, not typically public social media posts. Question 20. A registered representative, R, resigns from a firm. What is the firm's obligation regarding the RR's Form U5 filing? The firm must file a Form U5 within 30 days of termination, providing accurate and complete reasons for termination. B. The firm only needs to file a Form U5 if the RR was terminated for cause, not if they resigned voluntarily. C. The firm must wait for FINRA to request the Form U5 before filing it. The firm is not required to file a Form U5 if the RR immediately joins another FINRA member firm. Answer. The firm must file a Form U5 within 30 days of termination, providing accurate and complete reasons for termination. When a registered representative terminates their association with a FINRA member firm for any reason, resignation, termination for cause, etc., the firm is required to file a Form U5, Uniform Termination Notice for Securities Industry Registration, with FINRA. This filing must be completed within 30 days of the termination date and must provide accurate and complete reasons for the termination. This ensures that FINRA and potential future employers are aware of the representative's registration status and any disciplinary issues. The obligation applies regardless of the reason for termination or if the individual plans to join another firm. Question 21. A Series 10 principle identifies an instance of free riding in a customer's cash account. Which of the following is the most appropriate initial action? Liquidate the securities and impose a 90-day freeze on the account, requiring payment in full prior to trade execution. B. Issue a warning to the customer and allow them to make a good faith deposit. C. Immediately terminate the account and report the customer to FINRA. B. Liquidate the securities and transfer the proceeds to the firm's suspense account. Answer. Liquidate the securities and impose a 90-day freeze on the account, requiring payment in full prior to trade execution. Free riding occurs when a customer buys and sells securities in a cash account without ever paying for the initial purchase. When a Series 10 principle identifies free riding, the firm is typically required to liquidate the unpaid-for securities and impose a 90-day freeze on the customer's account. During this 90-day period, the customer will be restricted to purchasing securities only if they have sufficient cash on deposit prior to the trade, preventing them from selling before paying. This measure is designed to curb abusive trading practices in cash accounts. Question 22. A Series 9 options principal is tasked with supervising the approval of new options communication materials. Which of the following is a key regulatory consideration? Ensuring that all options communications are filed with the OCC prior to use. B. Verifying that options communications clearly explain the risks, are balanced and do not make exaggerated claims, and that required disclosures are present. C. That communications are targeted only to institutional investors with options experience. B. That options communications only use actual past performance data, never hypothetical illustrations. Answer B. Verifying that options communications clearly explain the risks, are balanced and do not make exaggerated claims, and that required disclosures are present. A key responsibility of a Series 9 options principle regarding options communication materials, retail communications, is to ensure they comply with FINRA's advertising rules. This includes verifying that the communications clearly explain the risks involved, present a balanced view of both potential risks and rewards, avoid exaggerated claims, and include all necessary disclosures. G. Options disclosure document availability. Options communications are generally filed with FINRA, if required, not the OCC, and can use hypothetical illustrations if presented fairly with clear explanations and disclaimers. They are not restricted to institutional investors. Question 23. A Series 10 principle is conducting the annual review of the firm's supervisory controls and procedures. Which of the following is a mandated component of this review according to FINRA rules? A complete overhaul of all existing procedures regardless of effectiveness. B. A statistically significant random sample of all customer communications. C. A written report detailing the results of the review, any identified exceptions and any corrective actions taken. An audit of all registered representatives' personal financial statements. Answer C. A written report detailing the results of the review, any identified exceptions and any corrective actions taken. FINRA Rule 3120 and 3130 require firms to conduct an annual review of their supervisory controls and procedures. A mandated component of this review is the creation of a written report documenting the findings. This report must detail the results of the review, any exceptions or deficiencies identified, and the corrective actions taken or planned. This ensures accountability, transparency, and continuous improvement in the firm's supervisory framework. While sampling customer communications might be part of the review, it's the comprehensive written report that is explicitly mandated. Question 24. A registered representative, RR, it provides investment advice to a client based on research reports published by the firm. The Series 10 principle discovers that the RR received material non-public information from an insider and traded ahead of the firm's research report for personal profit. This is an example of front-running. B. Interpositioning. C. Insider trading. D. Market manipulation. Answer C. Insider trading. The scenario described is a clear example of insider trading. Insider trading involves the buying or selling of a security in breach of a fiduciary duty or other relationship of trust and confidence, while in possession of material, non-public information about the security. The RR used material non-public information obtained from an insider and traded ahead of the firm's research report for personal profit, which is a classic definition of insider trading. Front-running involves trading ahead of a client's large order, while interpositioning involves inserting an unnecessary third party between a customer and the best market price. Question 25. Regarding the options disclosure document, ODD, which statement is accurate? The ODD must be delivered to a customer prior to or at the time of the first options transaction. B. The ODD must be delivered to a customer before their options account can be approved by a principal. C. The ODD is only required for customers engaging in complex option strategies, not for basic covered calls. The ODD must be filed with FINRA by the firm before it is provided to any customer. Answer B. The ODD must be delivered to a customer before their options account can be approved by a principal. FINRA Rule 2360 Options requires that the options disclosure document, ODD, must be furnished to a customer at or before the time the customer's account is approved for options transactions. This means the customer must receive and have the opportunity to read the ODD before a principal can officially approve their options account. This ensures the customer is educated about the risks and characteristics of options before they are able to trade them. The ODD is required for all options accounts, regardless of the complexity of the strategy, and it is prepared by the OCC, not filed by individual firms with FINRA before customer distribution. Question 26. A Series 10 principle is establishing supervision for a new branch office. Which of the following is a key regulatory requirement for the individual designated as the Office of Supervisory Jurisdiction, OSJ, principal? The OSJ principal must reside within the same city as the branch office they supervise. B. The OSJ principal must personally approve all outgoing correspondence from the branch. C. The OSJ principal must be physically present at the OSJ location to supervise the activities of that office and its associated persons. The OSJ principal must have at least 10 years of experience as a registered representative. Answer: C. The OSJ principal must be physically present at the OSJ location to supervise the activities of that office and its associated persons. A key regulatory requirement for an office of supervisory jurisdiction, OSJ, principal is that they must be physically present at the OSJ location to supervise the activities of that office and its associated persons. This on-site presence ensures effective oversight, direct interaction, and prompt resolution of supervisory issues within the OSJ. While experience is valuable and approval of correspondence is a supervisory function, the physical presence at the OSJ is a specific and critical regulatory mandate to ensure adequate supervision of a significant location. Question 27. What is the primary objective of the Know Your Customer rule for a Series 10 principal? To obtain a customer's Social Security number for tax reporting purposes. B. To ensure that the firm collects sufficient information about a customer's financial situation, investment objectives, and risk tolerance to make suitable recommendations and supervise the account. C. To identify potential money laundering activities by gathering information on the customer's source of funds. To confirm the customer's physical address for mailing account statements. Answer: B. To ensure that the firm collects sufficient information about a customer's financial situation, investment objectives, and risk tolerance to make suitable recommendations and supervise the account. The primary objective of the Know Your Customer (KYC) rule, FINRA Rule 2090, for a Series 10 principal is to ensure the firm collects sufficient information about each customer to make suitable recommendations and to supervise the account effectively. This includes understanding the customer's financial status, tax status, investment objectives, and risk tolerance. While collecting a Social Security number, identifying money laundering, and confirming addresses are important aspects of account opening and compliance, the overarching goal of KYC from a principal's perspective is suitability and proper account supervision. Question 28. A Series 10 principal discovers that a registered representative has established an arrangement to share in the profits and losses of a customer's account. Under what condition is this generally permissible? If the customer provides verbal consent. B. If the firm provides prior written authorization and the sharing is proportionate to the capital contributed by the registered representative. C. If the customer is a family member of the registered representative. Under no circumstances is profit and loss sharing allowed in a customer's account. Answer: B. If the firm provides prior written authorization and the sharing is proportionate to the capital contributed by the registered representative. FINRA Rule 2150. Sharing in accounts, lending to or borrowing from customers, generally prohibits registered representatives from sharing in the profits or losses of a customer's account. However, an exception exists. Sharing is permissible if the firm provides prior written authorization and the sharing is proportionate to the capital contributed by the registered representative to the account. This rule is designed to prevent conflicts of interest and ensure fair dealing. The only exception to the proportionality rule is for immediate family members, where proportionality is not required, but written authorization from the firm and client are still necessary. Question 29. Which of the following describes a key supervisory duty for a Series 10 principal regarding soft dollar arrangements under Section 28E of the Exchange Act? To ensure that all soft dollar payments are fully disclosed to clients in dollar amounts. B. To confirm that research and brokerage services received are directly related to the execution of client transactions and provide a direct benefit to the client. C. To verify that soft dollar arrangements are only used for proprietary trading activities of the firm. B. To prohibit all soft dollar arrangements as a conflict of interest. Answer: B. To confirm that research and brokerage services received are directly related to the execution of client transactions and provide a direct benefit to the client. Section 28 of the Exchange Act provides a safe harbor for soft dollar arrangements, allowing investment managers to pay a higher commission to a broker-dealer if they determine in good faith that the commission is reasonable in relation to the value of brokerage and research services provided. A key supervisory duty for a Series 10 principal is to ensure that the services received under soft dollar arrangements qualify for this safe harbor. This means confirming that the services are directly related to the execution of client transactions and provide a direct and quantifiable benefit to the client. Soft dollar benefits are generally not disclosed in dollar amounts, nor are they typically used for proprietary trading. Prohibiting all such arrangements is not required, provided they comply with 28. Question 30. A customer initiates a trade for 1,000 shares of XYZ stock, but the registered representative, R. He mistakenly executes the trade for 10,000 shares. Which of the following is the best course of action for the Series 10 principal upon discovering this error? Force the customer to accept the larger trade, as it was their instruction that initiated the order. B. Immediately cancel the entire trade and re-enter the correct order for 1,000 shares. C. Contact the customer to explain the error and determine if they wish to keep any portion of the mistaken trade, then adjust the account and document the error in an error account. Absorb the loss in the firm's proprietary account without informing the customer. Answer, C. Contact the customer to explain the error and determine if they wish to keep any portion of the mistaken trade, then adjust the account and document the error in an error account. When a registered representative makes an execution error, the Series 10 principal's responsibility is to promptly address it in a fair and transparent manner. The most appropriate action is to contact the customer, explain the error, and determine the customer's wishes regarding the mistaken portion of the trade. Any resulting gains or losses from correcting the error, e.g., selling the excess 9,000 shares, are typically borne by the firm, and the transactions must be documented in a firm error account. Canceling the entire trade or forcing the customer to accept the error is usually not the correct procedure, nor is absorbing the loss without informing the customer. Question 31. Under FINRA Rule 3130, regarding the CEO certification of compliance processes, which statement is most accurate? The CEO must personally review every single supervisory action taken by the firm. B. The CEO must attest annually that the firm has processes in place to establish, maintain, review, test, and modify written compliance policies and procedures, and that the firm's executive management has reviewed the report of the Chief Compliance Officer. C. The CEO certification is only required for firms with over 500 registered representatives. The CEO certification absolves all principals of their individual supervisory responsibilities. Answer, B. The CEO must attest annually that the firm has processes in place to establish, maintain, review, test, and modify written compliance policies and procedures, and that the firm's executive management has reviewed the report of the Chief Compliance Officer. FINRA Rule 3130 requires the CEO, or an equivalent senior officer, to provide an annual certification. This certification attests that the firm has processes in place to establish, maintain, review, test, and modify its written compliance policies and procedures, and that the firm's executive management has reviewed the Chief Compliance Officer's, CCO's, report. The CEO is not required to personally review every supervisory action, nor does the certification relieve principals of their individual supervisory duties. The rule aims to reinforce a culture of compliance from the top down, not to shift all responsibility to the CEO or apply only to large firms. Question 32. Which of the following statements regarding the annual compliance meeting is most accurate? The annual compliance meeting must be conducted in person for all registered persons. B. The annual compliance meeting must be held annually and cover compliance, regulatory, and ethical issues relevant to the conduct of the member's business. C. Only Series 7 registered representatives are required to attend the annual compliance meeting. The annual compliance meeting can be replaced by distributing written materials to all registered persons. Answer, B. The annual compliance meeting must be held annually and cover compliance, regulatory, and ethical issues relevant to the conduct of the member's business. FINRA Rule 3110, Supervision, requires member firms to conduct an annual compliance meeting for all registered persons. The purpose of this meeting is to discuss compliance, regulatory, and ethical issues relevant to the conduct of the firm's business. While in-person meetings are common, the rule allows for various methods, including WebEx or other electronic means, as long as there is an opportunity for interaction and questions. It cannot simply be replaced by written materials, as interaction is key, and all registered persons, not just Series 7s, are required to participate. Question 33. A Series 10 principal is supervising a registered representative who frequently uses social media for business communication. Which of the following is the most important supervisory consideration? Ensuring the RR uses only FINRA-approved social media platforms. B. Monitoring and retaining all business-related social media communications, and ensuring they comply with advertising rules and firm policies. C. Limiting the RR's social media activity to only professional connections. D. Requiring the RR to obtain written customer consent for all social media interactions. Answer, B. Monitoring and retaining all business-related social media communications, and ensuring they comply with advertising rules and firm policies. For supervising social media use, the most important consideration for a Series 10 principal is to monitor and retain all business-related social media communications, and to ensure that these communications comply with all applicable FINRA advertising rules. Fair and balanced, not misleading, and the firm's own written policies and procedures. Firms must have robust systems to capture and archive these communications, just like email. While using approved platforms or limiting connections might be part of a firm's policy, the core regulatory requirement revolves around supervision, retention, and content compliance of all business communications, regardless of platform. Question 34. What is the statute of limitations for filing a claim under the FINRA Code of Arbitration Procedure? 1 year from the event giving rise to the claim. B. 3 years from the date of the sale or the event giving rise to the claim. C. 6 years from the date of the event giving rise to the claim. 10 years from the date the customer became aware of the claim. Answer, C. 6 years from the date of the event giving rise to the claim. Under the FINRA Code of Arbitration Procedure, no claim shall be eligible for submission to arbitration if 6 years have elapsed from the occurrence of the event giving rise to the claim. This is known as the 6-year eligibility rule. This rule sets an absolute limit on when a claim can be brought, regardless of when the customer discovered the issue. Firms and principals must be aware of this time frame when dealing with potential customer disputes, as it dictates the eligibility for FINRA arbitration. Question 35. A Series 10 principal is reviewing a firm's due diligence process for new product offerings, such as a structured product. Which of the following is a critical element of this review? Ensuring that the firm only offers products from well-known issuers. B. Verifying that the firm has a reasonable basis to believe the product is suitable for at least some customers and that the associated persons selling it understand its features, risks, and costs. C. Confirming that the product offers guaranteed returns that exceed market averages. D. Requiring all registered representatives to personally invest in the new product before offering it to clients. Answer, B. Verifying that the firm has a reasonable basis to believe the product is suitable for at least some customers and that the associated persons selling it understand its features, risks, and costs. A critical element of a firm's due diligence process for new product offerings, especially complex ones like structured products, is to ensure that the firm has a reasonable basis to believe the product is suitable for at least some customers. This also includes verifying that the associated persons recommending the product fully understand its features, risks, costs, and liquidity. This reasonable basis suitability obligation applies to both the firm and the individual representative. Simply offering products from well-known issuers, requiring personal investment, or guaranteeing returns are not core elements of product due diligence or suitability.